Everyone. This is Mike Zlotnik, Big Mike, and I'm joined here by a couple of close friends, super wonderful folks. I've known them forever. Eddie and Martha Speed. Eddie is the cowboy from Dallas. I had the privilege of having Eddie's kids take me to the rodeo for the first time. It was the guy from New York, the big Russian or Big Mike from New York, being introduced to the classic rodeo in Dallas, Texas, by Eddie's kids, and it was just a blessing to have that. And Eddie and Martha has been close friends, so welcome. Appreciate you, and we also joined here by Ryan, who is on Tempo team. Hi, Ryan and Eddie, Martha, welcome.
Thank you.
Any quick thoughts? Where in the holiday season 2025, this whole conversation is going to be all about notes. Eddie runs NoteSchool, noteschool.com, with Martha, of course. Sorry, I just know they've been doing this together. And many years ago, I attended. It was wonderful then, and I'm sure it's wonderful now. And if you want to invest or ever consider doing anything in notes, or just learn how to invest in notes, or buy notes or sell notes, they are the foremost experts in the country. Like literally, I don't know anyone else who knows more about notes, not only have done many tens of thousands of notes, but have deep expertise and a school to help folks succeed. So Eddie, Martha, take us from here. Any quick initial thoughts?
Well, I think Big Mike, that one of the things that we always look at, I started with Martha's dad 45 years ago, right? Learning the note business. And so it's been quite a journey for us. But I would think that the most important thing that any real estate investor or any investor of any type learns is timing. You can't beat. The best thing you can do in the business is pick the right timing. And we are in a good timing for notes.
I think it's a market cycle thing.
For sure. It was caused by inflation.
So let's go back to the basics about the notes. Why is it a great timing now to invest in notes? Let's go to the basics. What is the concept of a promissory note? And you're playing a lender. You're being in a safer position, right, as an investor in a real property, being the bank versus being an owner of the property.
So when we say notes, we're simply saying that we buy first mortgages on property. Right. And we're buying typically long-term mortgages. We're not doing a fix and flip loan. We're buying a loan where people are paying back the house with interest over time, and you have a first mortgage on their house. So the reason that I think this all relates to the fact is Mike, that right now people are paying more interest than they're earning on rental houses, right? If you go get a DSCR loan in today's market, call it 7% interest, right? Well, the average rent house in the United States is making 4% before you pay the bank. So you're earning 4% to go pay 7% to the bank. Sounds like to me it's a great day to go be the bank. And that's really, the quick logic. That's why we say it's market timing. We've been doing notes Martha and I have been doing notes for 45 years. So it's not like we just started, but the timing's pretty good.
Timing is pretty good because the interest rates are high. Because interest rates are high, you're getting a better yield as a lender than as if you own that house and you rented the house. That's the key message here.
What has soiled the rental market scenario is inflation. That's what's caused cash flows to change in rental houses and apartments. That's what's caused it. The more expenses you pay, the less you net.
Yeah, and that's been kind of a surprise to a lot of people buying, turnkey houses where they basically, own the asset and they rent it out, or portfolios of those turnkeys, or built to rent. So today, the key message is it's better to be the lender, the bank, on these type of investments. You have a much better cash flow. You have a safety. What about inflation? What if inflation, you get paid in a mortgage fixed rate of return? It's the interest rate. What if inflation picks up?
Well, we're buying notes that typically yield anywhere from 9 to 11%.
So you're buying them at a discount. That's what you're saying.
Well, not necessarily even at a discount. It doesn't matter. A note's discounted because there's some kind of issue with the note that causes you to discount. The rule is you always buy discounted notes. That's a little bit of a myth, right? But the idea here is that I'm buying notes that yield a market rate that you can live with. And once again, I remember when 2021 in the beginning in 22, and Mike, you and I were in Facebook groups, and all these people were like blasting all over Facebook. The thing that you own in inflationary times is rent houses. And I'm calling BS. That's not true. And of course, I don't want to fight on Facebook, and I just didn't get into it. But I had a lot of close friends like you that I said, that's going to prove to be a myth. And everybody says, why? And I said, because I started in 1980 with Martha's dad. And 1980 proved to real estate investors things they didn't know before, which was inflation sucks the cash flow out of a rental.
Yeah, the maintenance becomes way more than you think. This is the crazy part. I've owned, and I still own turnkeys, and the experience is the rent increases quite often sometimes lag the speed of these inflationary costs. If you need maintenance, if you need the taxes go up, insurance goes up. We've seen faster inflation pressure last few years. Insurance skyrocketed, and it like you said, it sucks out the bloodline out of the cash flow when you have this cost inflation. And as much as you're trying to raise tenant rents, it's difficult. It takes time. It's not like a fast thing you can do. While the insurance can jack up the premium on you fast. So it's just better be a lender, right? That's essentially the conclusion of this. It's easier, more predictable, stable to be a mortgage provider, a note owner versus property owner.
Higher yield, more cash flow, right? For the same investment, you can earn 2.5 times more net income being the bank than you can a landlord in today's market.
From a cash flow perspective.
Yes, sir.
I guess total ROI, you're hoping for appreciation, right? If you own as an equity player, if the market appreciates, that's your, that's where you're picking up where your yield is falling behind.
When you get that much more cash flow, you're getting your appreciation. You're just getting paid for it now. You're not having to wait.
Yeah, it's kind of funny how all these value add growth opportunities with the high IRRs, they often don't pan out, but the cash flow is what you get and it's real.
Listen, 45 years in this business, Martha and I've been through a lot of cycles, and there are years that our note buying business hasn't done so well. Martha will tell you, we're right here at year end, the note buying space, the income has jumped way up. And it's a reflection of basically this market condition. Martha has a different perspective. Like you and I like yield and running the math and doing whatever. And Martha's got like a retirement investing model that just says, I want to make more investments with less trouble so that I can go be grandma and I can build legacy. And she's got a leveraging strategy where she can do this over and over and over and not tie up a whole lot of her capital in one deal. And then all of a sudden she's got a passive investment. And that's what I've learned at the end of the day, Mike. I'll bet you 90% of the people that are listening to this podcast, you could say, give me the highest yield with a lot of aggravation, or give me a little lower yield with no trouble. I'll take number 2.
So Martha, would you be so kind to talk a little bit about what you said? How does that work?
I'll be glad to jump in on that one. So I can say that the model that I use today was started over 50 years ago, because my dad and his partner were trying to buy and sell loans. And so at the time, the bank that they were trying to sell the loans to could only book 15 years, a 15-year note. They couldn't book a 20 or 30-year loan. They couldn't put that on their books. And so they were real quick on their feet, and they said, that's no problem. We'll be glad to keep the back end. So that's kind of how it started. The term is buy long and sell short. That's my dad just told us over and over and over again.
Buy long and short. So what does that mean?
What you're doing is buying a long-term note that might have 20 or 25 years, 30 years left. That's the amortization left on the loan. And then you're working with another investor who wants to be passive. They don't really want to have all the ins and outs every day of dealing with the actual asset, but they want the cash flow. And so that way you can sell, let's say maybe 10 years or 12 years or whatever it might be of the cash flow to another investor to recoup your investment in the loan. And you'll still have to have some, especially in like in a IRA, a Roth IRA, or traditional IRA, you still have to have an investment, but it's just correlates and you back into it based on, basically kind of the terms of the loan. I mean, you might have $1,000, $1,500 invested, and then you're recouping the balance of your investment. Um, the payment flow will go to your passive investor, let's say for 10 years, if that's what they bought, and then it reverts back to your retirement account. And so you can do this in a, 401k, you can do it in a solo 401k, you can do it any kind of retirement account, any type of business account. It doesn't really matter. It is just such a good model, and it has really, it's just a proven model, because I mean, I learned it right out of high school when I went to work for my dad when I was 17 years old. And so it has been 50 years, and I'm still doing it today. So it is something that works. It's a win-win for both parties. Your passive investor loves the fact that, like, I like to oversee the loan for them, but they can log in at any time and see how things are paying and, what's going on with the loan. So it just becomes a win-win for both parties.
Are you talking about the fractionals? Is that, from what I'm hearing, this is, unless you change the name, when I went to your NoteSchool, I clearly remember this is what you're describing is a partial,
Right.
and how it functions. It's very powerful. You're selling payments. You're selling front payments to an investor, and your original investment, your note that you bought the note with, retains small ownership, but it's such a powerful tool where with small amount of capital you could get a great return when you sell the front payments to an investor.
Well,
Explain how it works a little more.
Yeah,
it
let me
allows
correct
you.
something, Mike, before you say that, okay? Because this
What?
is really critical. It is not a fractional interest,
Okay.
okay? It is
I mean partial, not
it's
well,
a
you call it
partial.
partial. Sorry, if I
Because
said
for
fractional, I
people hear
apologize.
that,
No, it's a
like, that's kind
partial.
of a securities problem if you say that. This is not papered in that way. It's structured differently. But yes, that describing the leverage, Martha, that's the magic, right?
Right. So it is a sell of the asset to the partial investor. So if I own the loan, I'm selling to another, like 10 years to another investor. It is a sell of the asset to that investor.
Well, you're selling the payment stream, right? You're not selling the entire note. You're basically selling the first 10 years of payments, right?
Right. So we have an agreement that does outline how many years of the payments that they will be receiving. And then at the end of that, it will revert back to my account. But what on my end, then what I get to do is take that money, that I use for that acquisition, and just put it towards another acquisition. So then I buy another note, and I can do the same thing and sell a partial on the next note. So it allows you just to snowball the model. It just snowballs, because you can just keep using this capital that's coming, over and over again, and recoup it. You'll have a little investment in your IRA, out of your IRA with it. And then you just, it's like a cookie cutter. So you just keep doing that same model over and over. And it's one of the things that I think, if you look at models that stand the test of time, they all work like that. It's where 50 years later, you can still be doing that same model, and it will still be generating future income for you, because that's what we are doing. We're saying, okay, we are good now, but we want to retire one day, right? And so we want to have cash flow that we have, that we can depend on when we get, down the road and we're ready to retire. And so it's a perfect model for both parties.
So let's use an
I
example.
like I
So
said,
let's
it's not a fractional. It is a sell of the asset to them.
so let's use an example. Let's just go live to you buy a note, a mortgage, first lien mortgage, on a property, and just give live examples, dollar amounts, transaction, just
Here
something
you
that.
go. Here you go. Here's a timeline. Okay. I'm going to use my little drawing pencil, right?
Well, I think you want some numbers.
Some numbers. Give me
I'm
an
gonna give
example,
you
like a house in Dallas, Texas, and you're buying a note on that house and who you're buying it from, and who do you sell it to, and what are the numbers? Like specifically, a little more, like the numbers speak. Even though most people understand kind of how it feels, that it feels secure and safe, all that's Martha. But Eddie, you still numbers, I'm numbers. Let's cover both.
Well, here's what we're looking at. Okay, so when I buy a loan, I'm looking to see how long has the borrower paid on this loan, right? So the longer they paid,
Give
the more
example. So
likelihood that
give a live example.
they will have that they'll pay on the loan, right? And so and then then I'm backing into the terms to say, well, if depending on what I pay and if I can give you some numbers and it's not like set in stone. But let's say we want to say like there's $100,000 balance on the loan. Well, I might be paying, I might be paying 87,000 for it. It doesn't really matter. I might be paying more than that or a little bit less. And then what
But
I'm
you're
going to
underwriting to
do
yield,
is
right?
actually sell enough of the cash flow that I can recoup some of that investment. So I
So
would be
let's use a hundred
recouping
thousand
part of
dollar note.
the amount that I'm going to fund for the loan.
Martha,
So,
specific.
what now?
Can we be more specific? That $100,000 note, you're buying $100,000 note for $85,000,
Right.
trying to get to a certain yield of 10%, right?
Okay. Yeah, it might be 10%. I mean, it's all over the board. I don't have one in front of me. I'm at home.
But as an
Um,
example, you've done thousands of these loans. So
yeah. So,
what do you sell to who? Like you find an investor who needs to buy what?
so the majority of my customers that have come to me to buy partials have been, um, they're people my age. They're at retirement age. Most of them have already not working or they are to the point where they are getting close to retirement. Um, they've got cash available to invest and they want a safe, secure asset. So I'm selling them a cash flow that where a borrower has been paying and created a payment history, a good payment history. Um, they can look at the asset. It's a real estate. It's a sticks and bricks. It's a home. It's where they live. You can see pride of ownership. You can see, what the property is worth. So I might be buying a note with a balance of $100,000, but the house might be worth $200,000. So they've got a good cushion there if something did happen. But these are loans that are seasoned. They've been paying, and I find it's mostly people that they don't want to be active anymore in the business. I have had a lot of real estate investors that buy notes from me. But it's all over the board. It might be a doctor, it might be a lawyer, it's just people that we meet that in different, you know, groups that we go to and different things, different places we speak and that's what they're looking for. They're looking for somewhere to put their money where they feel like their money's going to be safe and they're going to earn a good enough return. It's not super high, but it's a good return. And so in the end, that I think that's what makes it work. Um, if I had, a case study in front of me, I don't know if Eddie has something, but if I had a case study in front of me, I wouldn't mind sharing it. I just don't have that specific numbers.
No,
You
but
know,
that's good enough. You said a couple of things. I'll just kind of regroup and maybe, I don't know, if Ryan, if you want to chime in with a question, and Eddie, you can put a little more commentary. But like a note that 50% LTV has been seasoned, $200,000 house and $100,000 note, that's a super low risk, right? And you're just selling investors a stream of payments for the first 10 years on that note. A very, very predictable, steady, feels safe, very downside protected. I'm just curious, Ryan, I don't know if you've ever heard of these partial notes, but this is Eddie and Martha have been doing this for a long time. So it starts with a fundamentally strong note, right? You got to start with a great secure collateral, great asset, and then you get creative that you bought that note, with 10% yield, and you're selling it to somebody the first 10 years of payments at annual yield of 8%, right? I'm just trying to remember how this thing that gets structured. So the person who is happy with 8% yield, uh, they create arbitrage for you of that, 8 to 10, and then you create a partial on it. You move all the cash flow up front to them, and you wind up with all the back end cash flow, which has a residual value. Is that how it functions, in essence? And any
Yes.
quick comments?
Yes. So with my investors, That's exactly how it works. So they're going to receive all of their money first. So if it's an $800 payment every month or it's 700 or whatever it may be, they're going to get that cash flow on a regular basis until their acquisition, whatever, if they bought 10 years, until the 10-year payment has completely paid out before it reverts back to me. So, and the thing about it is like they can pick and choose. I mean, I have assets where I can show them different assets, and when I work with an investor, they're going to feel comfortable that about the asset because they can choose that. I mean, it's so easy to do today. I mean, we have a lot of tools to where, that where they can go and actually look at the actual property address. And then on my end, I'm certainly giving them all the information on the loan, and then it's really, I think, in the end, when we go through the whole process, because it's just it's something that we don't do in at one time. It's a something we do over multiple conversations. And so, they learn about the business, and then they understand more and more about the asset and how it works. And so I think that's what one of the things too that just gives them a comfort level about owning the asset.
The typical profile or makeup of folks that are and the need you're filling essentially on your end for providing these types of notes back to homeowners? Are they folks that are refining out or into this vehicle, or are they unsuccessful in lending out other places? And I'm just curious.
Yeah, the underwriting profile today are people that basically can't go get a Fannie Mae Freddie Mac loan. And the underwriting criteria for a Fannie Mae Freddie Mac loan today is twice as tough as it was in 2019.
Yep.
So it's a big gap in the market that they've left. That in the loan origination business, they call them non-QM buyers, non-qualified mortgages. That just simply means you don't qualify for a Fannie Freddie loan. It doesn't mean that you're bad. And there's 40% of the loan origination business today are these same customers. Now, a lot of these customers that we buy are where the real estate investor has opted to seller finance them, right? Mm-hmm. And that doesn't mean that that's 100% of the loans we buy, but we teach real estate investors how to offer seller financing really with kind of all the guardrails of mortgage banking. And so we help them with that process. And that is, so the performance characteristics of these loans, meaning the loans that we pick, the likelihood you get paid promptly and as you expected in the future is a very high percentage shot. And we've got a very clear kind of an underwriting profile that we follow to do that. So it's, we've done it for many decades and tens of thousands of notes. And so we've got a risk management blueprint. Here's the question. You start out with the top of the blueprint. And the question is pretty simple. What makes me believe that they're going to pay me promptly in the future? And we go through that process of answering that question.
But you're also, you mentioned since 2019, and I know since that banking crisis a few years ago, I've heard it from friends of mine in the industry that are mortgage bankers or brokers or things like that, that there has been a real increase in the need for the secondary market, essentially because underwriting criteria or whatever other challenges are going on within the primary lending market has seen such headwinds. So you're really meeting that need for a lot of lending solutions that really still have a lot of value to them, I would think. And, at obviously a slight premium to that. So that's a great structure and great return for investors. So
it's not we don't perceive them. Experience has taught us. We don't perceive these people as a high risk customer. We just see them as a left behind customer. They've been left behind by traditional financing sources. Yeah.
Yeah. So what's changed? I guess the level of interest rates change because the high interest rates, you can offer a product that generates the 10, 11. I mean, you still need to make sure that the folks that borrow, they meet the Dodd-Frank underwriting. And they have to be able to afford the payments at the end of the day.
Yeah,
that's exactly.
no deal should be bought without underwriting, right? I mean, you have to make sure that you've gone through that risk management process to make sure that, and of course, that's why we have a school. It's the same practices that Martha follows every day or anybody in our shop. And, to us, it's now the common thing that we do, but you don't just shut your eyes and pick, right? You've got to make sure that you're convinced by a process this customer will continue to pay as agreed. And that's what says that cash flow is coming in. That whether it's the property value or their income that they make or their credit or their pay history, like whatever variables lead you to, they're likely going to continue to pay.
You have autonomy and ability to kind of tailor it based on the situation as well. The way you structure that. Do you ever do like an A/B note structure? Or I'm just curious. Is there a degree of creativity or flexibility that you offer that folks would not find elsewhere?
Mikey says, "Do I have a degree of creativity?"
Eddie is the most creative finance expert for most, probably creative finance. He is the foremost authority in the country.
Nice.
So I'm sure he tailors this for each situation accordingly.
Well, now I'm curious. So you have to tell me what some examples are. I don't know.
All right. Well, let's go to Martha's example. So I'm going to go back to where I wanted to go a while ago. Okay. So show this. This is my little pencil I draw with on my computer. Right? Does everybody see that?
Yes.
Okay. What I want to do is I want to say that's that 20-year cash flow Martha talked about. There's $1,000 coming in every month. Per month, $1,000 per month for 20 years. That's $240,000 over 20 years. Okay. So Martha buys that cash flow for $100,000. I'm going to just use super simple math. She buys that cash flow for $100,000. Martha turns around and sells half of that cash flow, right? The whole cash flow is this. I'm going to take my hand and she sells this portion, right? She sells that for $99,000 for $1,000 invested in that remaining portion. Now, she didn't get her money for 10 years, but for $1,000, it turns into $120,000 in payments over time if you wait for the money. That's creative. That's the way we creatively would do a deal on a retirement account.
So what you just did is you paid $100,000 for the note, for the stream of payments, and you sold the same thing for 10 years for same amount of money.
Well, 99. IRS said I had to have an investment.
99. So you're still left with $1,000.
You have to have an investment in it out of your, if you're going to do it in a retirement account.
Yeah, but the concept is the person who bought it for you, their yield requirement is lower than your original yield. I mean, you're creating that arbitrage. Like Eddie, you explain, maybe it's an extreme case. Maybe it takes you, for $99,000, you sell not 10 years of payments, but 12 years or 13 years, but right. You're still left for your $1,000. You're left with 7 years of $1,000 a month payments for $1,000 all in. So whatever it took you to negotiate to get that $99,000 from an investor, that's where creativity is. One investor might perceive it, I'm okay with 10 years of payment. Another investor could say, well, I really need 12 years of payments. But it's all creative, right? At the end of the day, for you, whether you sold 10 years, 12 or 14, you're still ahead because you're all in for $1,000 net.
Yeah, there's transactions that I might have more money in, but that's okay. I mean, because I'm working with an investor, and if they have a certain amount that they want to invest, and I've got a deal that works for them, I may have more money because I've had $20,000 that I won't recoup till the back end. But that's
understood. Okay. And that's what you teach in NoteSchool, right? That's the bottom line. You teach people how to think about it, how to understand how this works, how to do this creatively. And as Ryan, you asked the question originally, it starts with underwriting of the original note. What you don't want to wind up is you pay that 99, if you pay 100,000 for something that defaults in 6 months, and it's a problem for everyone at that point.
Creative financing doesn't fix a bad deal.
Yeah, you got to start with a strong deal, and then you can't put lipstick on a pig. It's still going to be a pig.
I was actually curious to elaborate on that. Who would be not a good fit for this type of vehicle, and what conditions would make a bad note environment essentially with a?
Well, I think first of all, if you're sitting in Martha's seat, and you're selecting these notes, you have to have some guidance and understanding based on historical information of what loans typically pay good over time. You can't accidentally know that, right? I mean, there's people make decisions based on two things: logic and experience. I'm going to tell you that experience way outweighs logic. You can think something's logical, but experience is the thing that's going to tell you whether that logic is true or not. Martha's operating with experience. Somebody comes to NoteSchool, we try to give them a compression of time. They don't have to have been doing this for 40 years like Martha and I have, because we're going to tell them in a very clear format, like what we've learned over 40 years. These are the type of loans that do well. These are the type of loans that don't do so well. And so those are the loans that you don't buy. These are the loans that you do buy, right? And so once again, I go back to kind of a simple explanation that most of your audience will have a clear picture of. Most everything in life is a risk management blueprint, right? A pilot going to fly an airplane. Okay. What's the pilot going to look at? Well, what's the weather conditions? What's the plane situation? Like if the weather causes the plane not to fly as normal, or the plane is not in good shape to fly, those are things that risk management says, the pilot says we're not going to fly, right? So everybody's been to the airport. Everybody can relate to that, right? Everybody's had to change planes or can't leave because of the weather. That's because the risk management blueprint that pilot used said it's not safe to fly. Well, when Martha looks at a note, Martha says, I like this note. The odds are this is the note that I want to buy. I look at this note over here that doesn't lead me to believe that they may not have trouble in the future. I'm not looking for trouble. She kicks that note out.
Eddie, so there's so much wisdom in through Martha's experience, right? That's why the wisdom comes with experience, right? It's not something you can easily teach. But I'm going to challenge you right now on this discussion. So we are, I crack the joke. We're not young cats. We've been around, right? Now we live in the age of AI. So now we're suddenly going to move into a territory where can you actually teach AI to do what you do and help automate that process? And the reason I bring it up is because you teach people how to do this through the school, and it's important. And then people walk away and then they still don't have your years of experience. You're giving them the tools, but one of the biggest benefits of current day and age, at least the recent developments, AI learns from, if you teach it, it learns, and you give it more data, it learns more. And as you continue to go through more and more, you could have a great helper. It still doesn't eliminate the wisdom, but it can do maybe 98% of your review with the right. I'm just curious if you guys are using AI as part of the NoteSchool tool set.
So we have a vendor that we use, and we've got strong ties with them. They are probably the ultimate technology firm in the mortgage banking industry. They have taught their AI how to do due diligence, and they've spread it over $1 billion worth of loans every month now for years. So AI is not new to them. They've been using AI extensively since 2018. And
even
so
before it was called AI, it was called something else. It was just called maybe expert system. It's one of the terms that people use as an expert system.
Right. So they are regarded in the mortgage banking, loan servicing world as probably the top firm out there that has built AI systems that build efficiency in the market. So we take a portfolio of loans and we drop it into their system, and now their AI system goes through. Now we do order a title search. We do order a BPO, but it's done through their AI system. And they evaluate the legalities of the document, the likelihood they're going to pay. They do all the analysis, and they identify things as problems so a human sees the problem. But probably 80% of our due diligence today is done by their system that they've built, which is automated and highly driven by AI. It's not exclusively AI, but it is highly driven by AI, and it still draws a human eye to the problem. And then that person can make a decision, disregard that in this situation, or yes, absolutely. And so, yeah, we We've drastically changed our efficiency in the business, and we think our accuracy of the business by using AI to do it. Now, the logic that we learned is the logic that AI understands. So you can't go to OpenAI because you don't know who taught it the logic.
Yeah. So what you just explained is the expert system. Again, it used to be called, that's the term, and now it's called AI. Critically important to train it on the massive data set. So it's a very custom version of data. So at the end of the day, you could use one of these AI platforms, but you got to train it. The data and the training algorithms and all that is critically important. So it's just better. This is instead of a generalized solution, it's a very specific solution, right? It's a specific to this industry where you look at a bunch of mortgages over time, over many cycles, and you've trained it, or your partner has trained it to make the right decisions. It doesn't care about anything else. It just knows how to look at these loans, and it knows propensity to pay based on borrower credit, but based on borrower financial situation, history of payments, et cetera, all this data. I think it's that's the secret sauce, right? It's got probabilistically, this person has an 89% chance to pay, and this person has a 98% chance to pay. And that difference may be in the decision, do you do this one or you don't? Would love to hear your thoughts.
Well, this is how we're doing business in 2025. It's not how we were doing business in 2021. And so we have been made available this vendor, this technology. They don't do it for everybody in the business. We're on the smaller end of clients they would do this for sure. But I have other, ties and relationships with them, and they've been willing to basically help us to do this. But I've been doing this for 45 years, and I would say it's the coolest thing I've ever seen in the industry.
Well, because of what I just said, in the last couple of years, the speed of learning, again, because of that expert system through AI engine now, and then the evolution, the crazy part is, at least, I'm not turning this into AI discussion, but I can only imagine this is one of the perfect areas where you could these learning platforms could learn quickly on the right data set, if you have the data set. And the evolution in the last, I don't know, 21 to 25 is already a huge difference. Even every 6 months, this thing must be evolving and improving and getting better and better. So access to the right tool is very important if you decide to invest in this or learn how to invest in this.
I'd say that I am long into a project that with this group that I believe will be the ultimate market disruptor in the loan space that doesn't relate to Fannie, Freddie, FHA loans.
So it's essentially a technology that's just underwrites this. It's almost like you take the human wisdom, and you could have Martha look at this thing, where you have an AI engine, and maybe
Right.
Martha would be correct or better, but the accuracy of this thing could get to 98% of Martha's ability, and it can process things way faster and with much more volume because of its, it can do this. Martha can maybe look at 100 loans a week, and this thing could look at 100 million loans a week.
That's right.
That's right.
We're trying to make sure that system agrees with Martha, that's what we're really constantly testing and looking over. We're trying to make sure that this underwriting that this system is doing, once again, I didn't say 100%. I said 80%. So we're still taking variables that AI has generated, or variables that ordering a BPO has generated, which is the valuation of the property, or variables that title search has identified. And we're still saying that a human decision maker that still needs to oversee the process at this point. So we're not just saying AI, go find the loans and do everything for us. But when you can give 80% of the work away to something else that is probably more detailed than a human, that's pretty efficient for us, right?
So it's really setting up the guardrails and then essentially having that kind of final review, right? So
That's it.
yeah,
That's the concept.
nice.
My guess would be it's 80% today. Give it enough time, it'll be 90 soon, and then 95. And well, that's the whole premise, right? I mean, that's why the AI stocks are, trading at crazy valuations, because if you give it enough time and the improvements, the productivity gains are such that, instead of spending, 100 hours a week. Now Martha could spend right now 20 hours a week, but maybe later it'll be 10 hours a week, and later it'll be 5 hours a week, because it'll be so much more accurate at its predictability capabilities in these decisions, and ultimately it'll be backed by the dollars invested. And of course, you need forward outlook on the data, but if the data is good, or if the past performance actually in this case on these loans is fairly predictable of the future outcomes, that then the propensity to succeed, this is a perfect like media for AI to be more and more efficient every cycle of that engine going through repetition. Give it enough time, within a year or two it might get to like 99% efficiency.
Yeah, once again, this company, this is not new to them. They have done literally hundreds of thousands of assets. And so they have had a lot of opportunity to train AI and make adjustments to what it understands and its logic. And so we are fortunate enough to go then get in on ride their train, so to speak, on a pretty mature system at this point. This isn't brand new. And once again, listen, I used AI yesterday afternoon asking it some legal questions, right? So, I mean, I'm like everybody else. It's very efficient, but I always know that I always have to question, like, okay, somebody taught AI that answer. Did they know what they were teaching, right? So you have to be a little bit careful.
It's still
thinking AI knows
hallucinating.
everything.
It can make errors. Yeah, for sure.
I've seen it absolutely be wrong.
Well, sometimes those things are also a real sounding board and echo chamber, right? They're not necessarily poking holes and testing arguments as much as we think. They might be good at pulling together and pulling together information, helping give it analysis and feedback, but at the same time, yeah, I can easily see the shortfalls as well. So where do you think the market is headed for you all? And I mean, obviously, we talk to a lot of investors. A lot of investors are looking at more stable, risk off investments, or things that they know have been really tested from an underwriting perspective. And I'm guessing you don't see any major changes in the lending environment, in the near term, to where there's still a real need here. Do you see continued growth in this sector for you guys, or what do you think in your crystal ball, what do you think the future is going to bring?
I don't believe that government agencies that provide residential mortgages are going to loosen their lending criteria. And I see that they are leaving a gap where common sense lending can come in and fill a void that they're not filling. We're not enemies with them. We're just trying to go figure out what void they're not filling, and does it make sense for us to fill that void?
This is a non-QM space, essentially non-qualified mortgage space.
Basically, it's that. And so we think that as long as we have inflationary times, there's a decent chance that being the bank is more profitable than owning the physical real estate. You can't take every story known to man and paste that over the top of it. But there's a good percentage of the time today, I'm going to pick on rent houses. I can almost guarantee you that it's unlikely that you got a rent house model that is more profitable than owning a note on the same house.
Yeah, that's the wisdom of many years, and exactly correct. It's kind of you started this whole lunch and learn with exactly this. It's almost as common sense as it gets in real estate. When the rates are high, inflation is high. Well, typically higher inflation, higher level of interest, right? It's higher level of interest. It's better time to be a lender because you get a better yield. You get better compensation for putting your money to work. The moment inflation comes down, it can, as a result of AI, productivity gains, right? If inflation comes down, suddenly you have an environment where things could shift, where it's better to be an equity player because of such a low cost of capital. Yeah, I mean, I'm just kind of observing on where, we play in the commercial space. In the short run, inflation is devastating for commercial because the interest rates spike. But in a long term, it could be a great friend too. At the end of the day, if interest rates come down, then it's better to be an equity player than a debt player. It's just a kind of common sense type of a discussion.
Now, Eddie and Martha, do you all have an online marketplace or anything like that where investors can look at these loan opportunities? Or I don't.
So at this juncture, Martha deals more with like the investors Martha deals with are really passive investors that don't necessarily want to go to note school. They just like her model. They believe that she's got a very effective section of the market that she's really good at. So she doesn't really deal with some massive amount of investors, but Martha's investors have one pattern, and that is they all tend to love Martha and love what she does. NoteSchool has built a marketplace. And so when people come to NoteSchool, then there's various levels that we kind of let them in the marketplace. We're not at a point in the market right now where somebody just goes with like almost no information at all and they just go on there and buy a loan. We're working at that. But right now there's a level of training we believe they need so they can make a good decision.
So you're still an educational platform, not a marketplace to just sell loans.
We've built a heck of a marketplace inside of NoteSchool, but we believe starting with NoteSchool is where you have to start.
And I agree. It always starts with education. It's okay. I've said this so many times, but this phrase is always on my. This is a question that I always pose. Most investors don't even think about it. But are you learning to invest or investing to learn? It's such a generic question. But at the end of the day, if you want to invest in notes, you need to invest in learning first. You need to know what the heck you're doing. You need to get better at that. With all the technology and all the AI, you still need to be kind of the CEO of your own money, as our friend Ryan Parsons says in his book. So it's kind of like you have to understand what are you doing with your money. As much as you love and treasure Martha, you still need, if you're buying a note, you need to do the basic due diligence, and to do that, to review that, you need to learn how to do it. So I think with Eddie, Ryan, I'm just kind of saying is at least spend the time learning the basics, and then you can start investing. And as you invest, you can now learn how is it, how do you get better at the next one?
Nice.
Any quick thoughts on this? So what do you teach folks in the NoteSchool? I know I remember going there for like 3 days, 2 or 3 days. You just go through the whole basics to kind of fundamental, foundational, and all that fun stuff.
Well, it's hard to teach any form of creative financing when you can't really get on a whiteboard and lay it out, right? I mean, so we teach specific examples. Here's a whiteboard. Here's the cash flow of a note, blah, blah, blah. Here's how you could structure the deal. You could use a leveraging technique like we described with Martha using the partial. You could just collect the payments and not use a leveraging technique. You say, I just want to buy it and get my money back. You can typically buy a 30-year note and get all of your investment dollars back in about 8 or 9 years.
Because of a discount, right? Because of a discounted.
Not because of discount. It's just because you bought it. You made an investment and you've got about a 10% yield, and you invest $100,000 and you get all your $100,000 back within about 8 years. That's just how the math works. Doesn't matter if it's
the capital that you put in, right? So this is
And if you bought a rent house, it would take you 18 or 20 years to get the same thing back.
Because of a lower yield. Yeah. Return on equity, the cash flow on equity is meaningfully less than cash flow. It's kind of funny that you say this, because I think of this every day, including the commercial, right? It's very, very different. But if you're looking for cash flow, you only have a few places where you can actually get a healthy, good cash flow. Private credit, it's exactly what you do. These are private notes. So private credit is your highest yield opportunity. The next thing we see is like a triple net industrial property or open air shopping, where you start with a pretty strong yield, still less than private credit. You have other benefits because you have depreciation and you have rent escalation clauses. So you're growing income over time in a triple net, absolute triple net industrial. But that's an equity play. But it feels very, very similar to a highest level of cash flow for the lowest level of risk, which is private credit, which is basically what you're doing.
So, we teach, I call that financial modeling. And we compare like rental property modeling to note modeling and how much money you can make and all that. The next thing we teach is the logic of this risk management blueprint. Like, what do we look for to try to find a good note? And we've been practicing teaching this for a long time, so we make it a pretty simple process. I just call it common sense. We just teach people the right principles, and then it just becomes a common sense decision. And so that we've got all kind of lanes that people can do. Some people come to NoteSchool and they have a lot of investable capital. Like they may have $1 million or $5 million they want to invest. We've had both, right? Pretty frequently. But then somebody comes there and they don't have a lot of money. And then they need to learn some leveraging techniques. And so those are the areas that we're trying to serve both audiences well. Of course, Martha's been, a poster child for being able to go do this, and not just our retirement, but she's taken it beyond that, where she's now helped our kids and now our grandkids with kind of a legacy model that she's mapped out because she understands how to use leverage. And she's been able to do things where we're not joking. We're projecting 20 and 30 years out of income that will come in. And so that's a pretty good technique that we have found that people are like, oh gosh, show me that. And so that's the kind of thing that NoteSchool teaches. The one thing, Mike, I would say is this, and kind of talking about NoteSchool, the art of simplicity is the best trait you can have in training. I can nerd it out with you on a whiteboard, but if I leave the rest of the class behind because you're a math genius, and I know that to be true, it's like, it doesn't matter. Our job is to make it simple. Our job is to make it to where people can understand it. I'm not a math genius. I just have been doing this for 45 years. I can hang with you doing the math, not because I have your aptitude. It's just that's what I've done every day for a really long time. So those are really important variables that we know in running a school. Is you start out with a simple path to success. And a simple path to success, quite honest, you should start in NoteSchool, and within 60 days, you ought to own a note.
Yeah, most brilliant things are usually simple. And I remember even going through, you start with as basic as it gets. It's almost to the point where if you're a mathematician like me, it feels, the word would be, it's a little slow pace. And I crack a joke on this, but it is not necessarily slow for any other reason other than you're trying to convey these basic concepts to folks that don't have expertise. They're not mathematicians, and you're trying to teach them fundamentally strong things in a simple manner. So I actually really liked it because you could take somebody who has nothing to do with this. They were a doctor or something else. And you could show them, listen, you got some money. Here's how you could put it to work at low level of risk and get cash flow and keep it simple. And you don't need a PhD in mathematics to understand this. So I think that's actually a strength, because simplicity could be genius.
Everybody wants to be Martha at the end, Big Mike. You know that. When they come to NoteSchool, they want to do what Martha's done. What we try to do is to show them a realistic path of how they go become Martha.
Yeah, I do concur and makes sense. And the bottom line is you're also helping them take action. At the end of the day, too many people, through all the training programs I've seen over the years, you have fairly small percentage that actually does something. They go to a school, they spend the time and the money to get their education, and they do what? Nothing. I don't know why it is, but 90%, maybe 95% of folks don't do anything. And then the 5% actually take action. There's nothing to do with NoteSchool. It has to do with the industry in general.
Yeah.
The 5%, it's kind of like, it's the 90-10 or 95-5, where a wide majority of the business is done by the 5 or 10%, and very little business is done by other folks. So that's
why we built a marketplace, Big Mike. The marketplace we built eliminated the biggest barriers to somebody getting started and being able to do this on a part-time basis.
You're giving them a vetted product, so they can come in and say, hey, Martha, look at this. This looks like a solid product. No guarantees. It's still risk, right? It's not known. Yeah. You might statistically look at this, and this is 95% chance of performance or 99% chance of performance, but that 1 or 5% may still have a default, and you got to be able to deal with it.
When we started being able to bring loans to the marketplace that our NoteSchool students did not have a seat at the table to go have access to, that changed our success rate drastically.
Yeah, because you're enabling them to. It's kind of funny. I remember many years ago, I asked you, Eddie, I'll give you a couple $1 million. You decide which notes to buy, and you still continue the NoteSchool. I didn't want to buy a bunch of small notes because I didn't have the time, desire, but I just want to deploy $2 million and get get the yield.
Yeah.
So at the end of the day, you're just helping people to deploy that $2 million or $200,000 or whatever that is to get the outcome through your vetted platform.
That's it.
Nice.
Very cool. How would folks like reach out? What's the best way to
Well, our website is noteschool.com. But what I would suggest to your audience is I would like to give them what I call a little opportunity class. And the opportunity class is like taken at a more granular level and showing them things like what Martha does and what the effect of it is. What is the opportunity, right? It's not so much a master class. I'm not going to take somebody an hour and 15 minutes and make them an expert in everything in the business, but it shows them the next step of what they could do that's possible. And they'll go to noteschool.com/tempo. And this is a class that we sell, but Big Mike's a long friend of ours, and we're going to give it to you guys to see if you like it.
Eddie, I appreciate that. For the record, we don't get any commission. I don't care. You sell a class. You consider your friend. I'm happy that you get the benefits of learning, and I can help you any way I can. I actually think it's a win-win for those folks who want to learn how to invest in private credit, promissory notes. This is hugely helpful, and it's not a free lunch. In fact, all the offers out there that give you free this, free that, you get what you pay for. If you are going to learn from the idiots and get free stuff, you're going to get that. And if they're going to buy your course, they're going to get expertise from somebody who's been in the industry for 40 plus years, and they're going to get quality education.
I may sign up myself because we're obviously just meeting for the first time. So this be interesting.
I think it'll make sense to you, Ryan.
All right. Sounds good. Looking forward to it.